Hello everyone. Today our topic is how to overcome the issue of fake invoices. Under indirect tax regime, the taxpayer is under obligation to collect and pay taxes to the government in a manner as prescribed. Under GST, Section 59 deals with self-assessment, which can be broken down as follows. Every person registered under the GST is required to discharge the tax liability on a self-assessment basis by filing periodical returns as prescribed under Section 39. Self-assessment means that the taxpayer himself shall determine the output tax payable and discharge the output tax after offsetting the ITC available, if any. Since self-assessment is in the hands of the taxpayer, he may misuse such opportunity. One such misuse is the excess claim of ITC and reducing the payment of tax in cash. If such excess claim is out of fake invoices, then it's an offence committed under Section 122 of the Act and shall be liable for punishment under Section 132 of the Act. Statistics and volume of fake invoices under GST. According to the press release by the PIB dated 13/7/2021, the CGST zones and the Director General of GST Intelligence have booked about 8,000 cases involving a massive fake ITC, which can be tabulated as follows. For the financial year 2021, number of cases booked were 8,000 and number of people arrested were 24, and the amount of fake invoices involved is 35,000 crores. For the financial year 21 and 22, number of cases booked were 500 and the number of people arrested were 426, and the amount of fake invoices involved is yet to be known. Apart from the above, various commissionerates from time to time are bursting the fake invoice rackets to protect the interest of revenue. According to one survey, the proportion of fake ITC to total collection can be anywhere between 1% to 5%. From the above, it is clear that the fake invoice is a serious issue and need to be curbed at the earliest. Concept and definition of fake invoices. One of the popular way of generating fake invoices is setting up a fake company and issuing fake invoices with GST without actual supply of goods or services to the companies within the group or known persons for sale. Issuing an invoice allows the recipient to claim the ITC. To put a check against the creation of fake firms and passing on benefit of bogus ITC, the CBIC has come up with stringent rules with respect to registration and makes it mandatory for Aadhaar authentication or physical verification. Fake invoice would generally involve the issue of tax invoices for a transaction which is not merely in existence to provide an opportunity to the recipient to avail the ITC. The issuer of the invoice may pay their tax liability through fake ITC claimed without receipt of goods or services or would not file their returns. Thereby there is no flow of tax to the department. This can be understood clearly with the help of press release by the CGST Agra Commissionerate dated 19/8/2021. Synopsis. The amount involved here is taxable value of 184 crores and fake ITC 32 crores. The Anti-Evasion Branch of CGST Agra initiated an investigation against a registered person which was non-existent and involved in passing on ITC fraudulently without having any inward supplies, and the process of passing on fraudulent ITC is as follows. Creation of fake firms on the identity proofs of fictitious person or unrelated person with the same firm name but different proprietors, and opened bank account with the name of bogus firms. Then they started issuing fake invoices without actual supply of goods or services to pass on huge fraudulent ITC to the recipient firm, and they also started the availment of fraudulent ITC passed on by the suppliers who are also bogus or non-existent. The registered persons involved herein committed an offence under Section 132 and hence were arrested under Section 69. Difference between proper invoice, improper invoice and fake invoice. Invoice or bill document as prescribed under Section 31 of the Act, read with Rule 46 of CGST rules. An improper invoice. An invoice that is not in accordance with Section 31 of the Act or Rule 46. Fake invoice. An invoice raised in accordance with Section 31 of the Act and Rule 46 with an intention to evade tax or to claim excess ITC. On a lighter note, fake invoice equal to original invoice plus absence of transaction. Characteristics of fake invoice. It is more likely to be object-oriented and object-specific. It is more likely to be intentional. Can be both in physical form and electronic form. It can be at a transaction level or at a recording level or at the time of filing return. Fake bills can be intended to mislead the intended users. Purpose of fake invoice. A fake invoice is solely raised for the purpose of undue excess claim of ITC or showing excess turnover or for fraudulent refund or for any other purpose. Scenarios. Bill has been raised but there is no movement of goods. Fictitious entries made at the time of preparation of books of accounts. Excess disclosure of turnover based on fake invoices. The implication of fake invoices accounted in books of accounts are as follows. Under GST, excess of ITC thereby evading tax or fictitious turnover to pass on bogus ITC. Under income tax, excess claim of expenditure thereby reduction in turnover resulting in underpayment of income tax. Under Companies Act, in case of inward invoices, Excess expenditure resulting in lower profits and undervaluation of assets and liabilities. In case of outward invoice, excess turnover, thereby inflating cash and other assets. In both the cases, it misleads the intended users. Fake invoice, an offense. Provisions of Section 122 and 132 deals with offences and punishment for the offences committed under this Act respectively. For a limited purpose, as per Section 122 of the Act, where any taxable person or any other person is involved in any activity of issuance of bogus or fake invoice without actual supply of goods or services or both, or availment and or utilization of ITC based on this false or bogus invoice, or collect any amount of tax but fails to pay the same to the government beyond a period of 3 months, shall be an offence under this Act. Such person shall be liable to penalty as determined under Section 122 of the Act. Section 132 of the Act specifies the punishment for various offences under this Act. Punishment for the offences under this Act are mutually exclusive, that is, each and every subsequent offence under this Act shall be punishable with such punishment and further such additional punishment for subsequent offence as applicable. The section categorizes the offences as cognizable, non-cognizable, bailable and non-bailable offence. All the above mentioned offences under Section 122 are cognizable and non-cognizable offences under Section 132. Punishment for offences under Section 132 are as follows. If the monetary limit is 5 crores or more, then the imprisonment can be up to 5 years plus fine. If the amount involved is more than 2 crores but less than 5 crores, then the imprisonment can be up to 3 years plus fine. If the amount involved is more than 1 crore but less than 2 crores, then the imprisonment can be up to 1 year plus fine. In case of false records, obstructing officer or tampering records, there is no monetary limit and the imprisonment can be up to 6 months plus fine. It may be noted that the punishment under the section is in addition to the penalties or fines as applicable under the respective sections. How the department can detect the fake invoices. The important tool that the department has to detect the fake invoices is the returns furnished by the taxpayers themselves. On certain parameters, it is likely possible to detect the presence of fake invoices, which can be explained as follows. Input-output ratio. In this method, the department shall compare and analyze the input rate of tax and output rate of tax. For example, Mr. A is involved in the business where the rate of tax is as follows. Input tax rate 12%, output tax rate 18%. Ideally, the taxpayer has to pay tax of 6% in cash, as it is the difference between the input and the output rate of tax. If Mr. A paying 100% of tax through ITC, then the department may inquire the same. It may be noted that not every 100% utilization of ITC is to be doubted. However, in certain cases, it's an indication. Statistical method or analytical tools. The department has various tools and facilities to generate various reports on various parameters. For example, the department may study the trend of utilization of ITC over a particular period of time. In case where the department has found there is a significant variance in the trend, it may proceed to inquire further. Likewise, it may also analyze the HSN summary of the supplier and the recipient, and in case of discrepancies, it may proceed to inquire further. Failure to furnish return. One of the indicating factors of fake invoices is not filing the returns properly or not at all filing. It is a well-known fact that the companies issuing fake invoices will issue the invoices for the purpose of claiming ITC and do not file their return. There might be another scenario where the companies issuing the fake invoices file their GSTR1 but not GSTR3B, giving additional benefit to the recipient to claim the ITC. Collecting data from various sources. Recently, the CBIC and CBDT have entered into a memorandum of understanding to share the data between themselves. Further, a significant change has been brought to the income tax portal, where the facility of turnover declared in the GST portal can be seen in the income tax portal. Apart from this, there are many other ways like banks, financial statements disclosed by the companies, etc. Burden of proof. As per Section 155, the burden of proof to claim the ITC shall be on the taxpayer. However, in case of fake invoices, the department should have fair enough grounds to dispute the same. How to put check on these fake invoices? Fake invoices are a serious threat to revenue. By passing on the benefit of fake ITC, the recipient utilizes the same to discharge the ITC, thereby causing revenue loss to the government. Hence, the government has taken few steps to curb the same, which are as follows. Rigid registration process. As stated earlier, the issuance of fake invoice involves setting up a fake company which do not operate from place of business as declared. Hence, the government has brought amendment to the registration by notification number 62/2020. As per the amended rules, the supplier needs to opt either for Aadhaar verification or physical verification of place of business. Recently, the department has initiated fake registration drive to curb the fake firms, thereby putting check against the fake ITC. Restriction on availment of ITC. There might be a scenario where the issuer of the fake invoices shall file GSTR1 but not GSTR3B. Hence, the government came up with Rule 36(4) that places a restriction on availing of ITC to the extent of ITC reflected in GSTR 2B. Restrictions on use of ITC available. While Rule 36(4) places a restriction on availment of ITC, Rule 86A and 86B places the restriction on utilization of ITC, which is as follows. Rule 86A. As per the said rule, where the proper officer has a reason to believe that the ITC availed is by fraudulent means, shall freeze the ITC, thereby the said ITC availed shall not be available to set off against the payment of tax or for refund. Rule 86B. Where the taxpayer has exceeded the limit of 50 lakh turnover in a month, excluding the turnover of exempt, export, zero rated supply without payment of tax and RCM, shall mandatorily discharge the tax at the rate 1% in cash. E-invoicing. The GST Council has approved the e-invoicing in its 37th meeting. Unlike the grammatical meaning, e-invoice does not mean generating of invoice electronically, but an identification number will be issued against each invoice which is generated by the taxpayer through various accounting softwares by the IRP to be managed by the GSTN network. All the invoice information will be transferred from this portal to both GST portal and e-way bill portal in a real-time basis. Conclusion. Fake invoices are a major cause of loss of revenue to the government, and it also results in the misuse of money of genuine taxpayers. If the same is not curbed at the earliest, it might result in heavy hardship to the taxpayers and the business. A few steps taken by the government may help to restrict the same, but the existence of fake invoices cannot be removed completely.